So all of you, namaste, good evening for coming down to this session organized by the Committee on Economic Commercial Laws and Economic Advisory of ICAI, headed as a chairman by CA Dr. Rajkumar Satyanarayan Adukia and Chairman CA Hansraj Chod. I welcome our renowned speaker today, CA Sanjeev Shah. He's a chartered accountant and a company secretary and has over 25 years experience. He works in Deloitte Haskins and Sells LLP in M&A tax and specializes in regulatory laws like exchange control, company law, security law, banking, etc. He has advised clients on structuring, restructuring, merger, obtaining approval from RBI, SEBI, CCI, DPIIT, banking license, NBFC license, corporate governance, due diligence, so on. He is a regular speaker in public forums of ICI and ICSI, Chamber of Tax Consultants, and has co-authored budget publications of WIRCI, monograph on SEBI insider trading of BCAS, and wrote various articles on corporate law. Sanjeev's name has been cited for his involvement in setting up of Bandhan Bank in the book Bandhan, The Making of Bank by author Tamal Bandyopadhyay. So all here to you, sir. Please enlighten us with what you have today so that we can take it ahead with the fraternity.
Yes, thank you. Thank you, the committee members, for giving this opportunity to speak at such a huge forum. I will, and I also thank Sudha and the other members for giving this opportunity. So what I'll do today is that I'll share in terms of what the ODI regulations are under the FEMA provisions, and share some of the practical experience around that. So let me just share my deck, see if you're able to, once you're able to see. I hope the deck is visible. Yeah, okay, great. So thank you. What I'll cover is mainly around the rules and provisions of RBI around overseas investment. As you know, under the foreign exchange law, there is a capital account transaction, current account transactions, and there are several provisions, regulations, master direction which Reserve Bank has issued from time to time. The one that I'll touch upon today is on the capital account transaction and on the outbound investment leg. So, we heard a lot about FDI. I think some session already have gone yesterday for FDI. What I'll do is, going outside India. So Indians, shopping abroad and in terms of, acquiring various companies. So, these are the regulatory laws in terms of some of the key, circulars and amendments and schemes which Reserve Bank has issued. So if one has to, advise any client and look for, any filings and assistance, then these are the piece of legislation that one has to go through. Apart from, Section 6, which is a mainframe provision under which, all these regulations are flowing. There are also Reserve Bank also has issued FAQs. So certain situations where, Reserve Bank has given enlightenment and clarity by issuing the FAQs. So all in all, one has to read all of them to kind of, give a holistic advice on ODI. So let me begin, set the context by, introducing some of the key definitions under the ODI regulations. So the first and foremost is the direct investment outside India. So essentially, it means that the investment by way of contribution to the capital of a company, now whether it's a fresh capital or a subscription to the capital, and or it can be through purchase of shares of any company. There are, we will come to this term very regularly. So while we talk about overseas investment, it is not just the investment. There are, various other support facilities which also Indian company provides to their overseas investee company in the form of loan guarantee. So all of these, are clubbed together as financial commitment. So FC or financial commitment is something which is very common terminology. So any amount of investment made by way of equity, or then by loan or guarantee, or even giving performance guarantee, all of these are considered for determining certain eligibility limits and certain approvals. Indian party, the regulation by and large talks about Indian party, which essentially means company and also an LLP, which is wanting to make an overseas investment. And then the partnership firm, which is registered under the partnership firm, under the Partnership Act. So unregistered partnership firm are not recognized as a Indian party. Investment banker, yeah, if it is India, the one which is registered with SEBI, and if it is with overseas, these are the one which is regulated by the overseas regulators. This has a relevance in terms of doing the valuation and from whom the Indian company should take the valuation. Joint venture, it would mean that any foreign entity which is either formed, registered, or incorporated under the laws of overseas jurisdiction, in which Indian party makes a direct investment. So so there are two things: the joint venture, as you can see on the top, and then wholly owned subsidiary, as what we see at the bottom, which is then fully owned by the Indian party. Net worth, this is a very important term, under the ODI context, especially in terms of determining how much one can invest, how much one is allowed to put the money. So ODI regulations defines net worth as a sum of paid-up capital and free reserve. Now, free reserve, it is defined under the Companies Act, which essentially means that a reserve which has been which as per the last balance sheet is available for distribution or dividend. So, item like profit and loss account, general reserve, these are the one which are available for distribution or dividend, is something which is, can be considered a part of net worth. But importantly, Companies Act also defines net worth, but RBI chosen not to refer that definition to the Companies Act and have given their own definition. I would say the main striking difference between the net worth as defined under ODI regulation, which is capital plus reserve, reserve is the net worth defined under the Companies Act, is that under the Companies Act, it also talks about security premium, which company collects when it issues shares. So this has been excluded from the calculation or definition of the net worth under ODI. Real estate business, essentially, the relevance is more in terms of what are the activities not permitted if you have to make an overseas investment. So any buying or selling of real estate or trading in the transferable development right are treated as a real estate business. I would say that more or less the definition is similar to the one defined under the FDI regulation for inward remittance, inward investment in India. Anybody wants to have a township or residential complexes, roads, bridges, infrastructure things are not a real estate business. They are completely allowed under the construction or a infrastructure space. So having seen the definition, the whole regulation capital account transaction operates. Now, whether we talk about FDI or we talk about ODI, essentially there are two routes. One, something which is called under the automatic route, or it's like free entry, free exit kind of a route, where you just make the investment as long as there are no roadblocks. You meet the eligibility requirement thresholds, you can make the investment. You don't need Indian party, don't need any government of Reserve Bank of India approval for making overseas investment. So that's on the left hand side, which is we call it as an automatic route. And then something which doesn't qualify under automatic route goes under the approval route. So, if one or more of the eligibility criteria or the conditions for investments are not met under the automatic route, one has to, make an application to RBI and take specific approval for making overseas investment. These are something which are prohibited investments altogether. So Indian party cannot make investment in real estate and banking business. Also, overseas entity where the Indian party has invested, they cannot offer any financial product which is linked to the Indian rupee. Whether we call it as a currency, swap or a stock indices linked to market or rupee exchange rate. So none of this product can be offered by the overseas entity in which Indian parties have invested if those are linked with the Indian rupee. If one wants to do any of this, then you need to make a case which has to be a very specific bona fide case and make to RBI for taking approval. So let's look at who are eligible entities to make investment. So we have seen Indian party, that definition, which essentially covers company, limited, LLP, as well as partnership firm which are registered. But then, there are other entities also, like registered trust or a society, mutual funds, proprietary concerns, individuals. We as an individual are also allowed to make investment in overseas companies, under the LRS rule. There are certain, general permission which RBI has granted upfront only. If the Indian party wants to invest funds out of his resident foreign currency account, or is getting bonus out of his existing investment in the Indian company, then that is something which is allowed under the general permission. General permission is granted even for somebody having invested. If you want to sell the shares subsequently, then that permission, then that those are something which is allowed to the Indian party. So we looked at the two angles for investment route, automatic and approval. Now let's look at very specific into what are the conditions for a automatic route. So under automatic route, the Indian party is allowed to make financial commitment. So I mentioned in the beginning, there is a FC, financial commitment term, which essentially has equity, loan, guarantee, etc. So an Indian party can have exposure in the by way of financial commitment in the overseas entity, which can be JV or a WS, up to 400% of its net worth. As per the last audited balance sheet. So up to 400% of net worth of the Indian investee entity, they can make overseas investment for any bona fide business purposes. If the investments are, you can make this, route this application through the authorized dealers, do the valuation, remit the money. But in case, if the overall exposure is going beyond $1 billion, then even if the exposure, if it is well within 400% of the net worth, then a specific case will have to be made to RBI for approval. So let's say if the Indian company net worth is $500 million. So in that sense, in terms of 400% eligibility, they can invest up to $2 billion. And if the company has already invested, say, 800 million and wants to invest, maybe 300 or 500 million more, that would take the financial commitment above $1 billion. So that would require RBI approval because of the threshold which they have set for taking specific case. Indian parties, can extend loan, they can give guarantee to the overseas entity, but this is allowed only if there is an equity investment in the foreign company. So Indian company wanting to guarantee any loan taken by overseas company, or give a loan to any overseas company, it is essential that Indian party has first an equity exposure in that, or equity contribution in that. So one Indian party need to be an equity shareholder in that, and thereafter loan or guarantee can be given. Now there is no specific percentage mentioned as to how much I can have. So if it's a JV, which an Indian party is formed abroad, by having even say 5% or 10% of equity investment, the Indian party can give a guarantee or a loan to the overseas party. And in case there are some business case specific case, and you need to give a guarantee without having any equity contribution, then you need to take a specific RBI approval under the approval rule. One condition for any Indian party to make overseas investment, that it should not be banned by RBI under the provision of FEMA or through enforcement provisions. So Reserve Bank under export regulation uh, creates an obligation on the party to realize their export proceeds within certain time. So the time keeps on changing. Currently, the time period for realization of export proceeds are 9 months. If it exceeds that, one has to apply, take the approval of AD Bank, and just see that they recover the money. If the amount of exposure, the receivables goes beyond certain limits, and despite all provision or all efforts, the money is not realizable, nor Indian company is able to demonstrate the case, or take a write-off or whatever under certain condition. And if then RBI believes that there are some reason for them to be cautious, then they put that Indian party exporter into caution list. So any Indian party which is into the caution list, if they have to make overseas investment, then it will not be allowed under the automatic rule. They need to take the specific approval from RBI. So anyone qualifying under, any Indian party name falling under exporters caution list, or where there is any investigation is been done by the enforcement directorate or any regulatory authority, then they will not be allowed to invest overseas under the automatic. When you make the investment overseas, obviously India has this provision of reciprocity for investment. Since in India, if somebody wants to come from abroad, investment is allowed subject to sector limits. And one April 2020 condition which talked about taking government approval for investment from a neighboring country who wants to invest in India. But barring that, anybody from overseas can make investment in India. So similarly, India is also one of the party to the FATF list. It is in a I would say has been categorized as one of the country where we can make investment. It is categorized by FATF as a valid jurisdiction with having proper checks and balances. But then there are certain countries which FATF, the Financial Action Task Force, defines it as a country which has certain non-cooperative kind of arrangements, or where they do not comply with KYC, anti-money laundering, and anything. And in that case, they put those countries into some blacklist or grey list. So they have their own classification. So if somebody is going, entities classify some country, if where India is wanting to invest abroad, and if that country is into the non-cooperative list of FATF, then one has to take a specific approval from RBI to do that. This FATF list, we can get it on the FATF website. So anybody has investment in some country which is not kind of lesser known, or where it is not less traveled, I think on those countries one need to just check whether they are falling in the FATF list or. Investment in Pakistan is allowed under the automatic approval. I think specifically RBI has put this point as a part of its direction to say that neighboring country is allowed. You can invest in Pakistan, but you need a specific approval from RBI. The last point is an important one in terms, the way you want to do your business and you want to have a ease of remittance, inward, outward, etc. when you make overseas investment or when you sell. So RBI said that if you want to make overseas investment, make sure that you route this only through one AD bank, one branch of an AD bank. So if Indian party has chosen to deal, say, with a particular bank, then that bank may have several of branches. It may be hundreds or thousands of branches, but you select a one particular branch and route all your transactions relating to investment, sale, etc. through that branch only. In case somebody is Indian party is opting for another bank or another branch of the same bank, then you need to take the clearance or a no objection from the existing branch and also write to RBI before you change the AD bank. Otherwise, it is viewed as kind of a violation of the condition of non-compliance. So financial commitment. I did mention about various way in which Indian party can have exposure overseas. So you can invest in the equity or compulsorily convertible preference shares. Exposure can be also through preference shares which are redeemable. Loan is allowed, guarantee is allowed. Any amount of bank guarantee which is issued by Indian bank of the Indian party is also considered, and where there is a counter guarantee given by the Indian party will also be counted for the overall financial commitment. And if there is any performance condition guarantee given, where there are certain conditions to be met upon occurring of certain performance based criteria, then that guarantee also can be given by Indian party. We saw that exposure under automatic route, total foreign financial commitment up to 400% is allowed. So in that 400%, the 100% weightage is there for equity, preference shares, redeemable or redeemable loan guarantee. But for that performance guarantee, only 50% of amount will have to be taken for counting the overall, the exposure. Now, it is very common for the rising or startups, or even for some of this new fintech and new age businesses, where there is a holding company, and holding company has floated many group companies, subsidiary, etc. And different company wants to make overseas investment, but somehow it is possible that balance sheet of the parent is very strong, but the balance sheet of the subsidiary may not be that much strong or heavy enough to allow to make the overseas investment. Which in case then is little bit a challenge, because if Indian party, the subsidiary, if they want to invest overseas and if that amount is going beyond 400%, they need to take RBI approval. So what RBI has done is they have taken that position of a consolidation, I would say, in accounts. So here also that concept of the seeing from the the holding company's point of view or a consolidated position is something which is allowed. So if you have to reckon the net worth of Indian party, the net worth of holding company in which the say subsidiary has so 51% is held by Indian subsidiary by the Indian holding company, then the Indian subsidiary can ride on the net worth of the holding company for having the 400% limit. Or also Indian holding company can also count the net worth of the subsidiary in which it holds at least 51%. So while it is very clear that holding subsidiary you need to have some 50% plus one, RBI said that okay, we have a 50% stake, and this 51% stake is purely in terms of equity. So control, if there is a holding subsidiary relationship established through mere control or having deputation or the board seat, but not the equity seat, will not be considered for the purpose of considering this overall eligibility for the threshold. So that maybe this is the first question that I put up. So I think in the last smaller format, I do open the matter that thing for discussion. But since we have such a large audience, I'll just leave the question to you for read. Maybe you please see that when you say that 400% of net worth has to be counted, what is it? Is it that I'll count that 400% every year, or I will count 400% of my net worth every time I make investment? Maybe I make multiple investment during the year. Say if my net worth is say 1,000, and in July, if I make investment, I can invest up to 4,000. Let's say I made investment of 4,000. Now come in November, I want to invest additional 2,000. Can I, still say that 400% of net worth? I have that, my proposed amount is less than 400%. Can I make? So is option D, having testing this 400% each time, is something what RBI considers, or it is considering a cumulative? So anything which I have invested in the past, so not necessarily past means this year, but even the past investment, if I have made some investments in the past, and if I am now proposing something in the future, then I'll take 400% of net worth as per my March 22 balance sheet, reduce from their past investment, also then check what is the buffer available, and see whether the proposed investment is within that of. So is that really, option A, B, or C, what RBI considers for the purpose of 400% net? So I think since I'll mention the response also. So the position has to be taken, which is option C. One has to take the wholesome position, a consolidated position at the point of time when I'm making investment, considering my past investments as well. So let me. So this is another interesting thing. Investments under automatic route, the valuation aspect, which is very key one. Anytime Indian party wanting to make overseas investment, there is a need to do the valuation. If the investment is more than $5 million, then the valuation has to be done by the merchant banker registered with SEBI, or it can also be done by overseas investment banker or merchant banker who is registered with the appropriate financial capital market authority in the host country. So the valuation will have to be done by the merchant bankers and the like. In case the investment is less than $5 million, then up to 5 million, rather, in case investment up to $5 million, then the valuation can be done by chartered accountant or a certified public accountant of the home country. So important, one has to keep in mind when one takes a specific, valuation from any authority. The service, the valuer. If there is an investment done through swap of shares. Now, swap of shares is Indian company making overseas investment, and then the overseas party in turn is issuing shares. So we are not talking of, say, holding subsidiary, etc. But let's assume pure JV, because under Indian company law, subsidiary cannot hold shares of Indian company. But if there is somebody which has overseas parties already, if there is a deal where there is a swap of shares, where Indian company will issue its shares to the foreign party, and the foreign company will in turn satisfy that consideration by issuing shares of that company, then it's a swap of shares. And in such case, regardless of the value of the deal or a transaction, the valuation has to be done by the merchant banker or the the equivalent investment banker or merchant banker of the host country. Now here, the question will also come whether we need government approval or. So, if the Indian party's business is under automatic route, then one don't need any government approval. Automatic route is allowed. But if Indian party's business is under some restricted category where you need prior government approval, then even for swap of shares, before the swap happens, both the companies issue shares. Indian party has to take government approval, the DPIIT, and then only the swap of shares even for FDI and ODI can happen. We did touch upon the FATF list. The last item on this bullet is very important, and these are essentially done many a times to float number of vehicles, maybe to with sometimes with the object to create more and more layers and more companies. So what Reserve Bank has laid down is that any investment in JV or WOS overseas is allowed through some special purpose vehicle, and under automatic route it is possible if you could satisfy the other standard condition about the eligibility 400% net worth. But important to note is the portion highlighted here that you can do through the medium of SPV. So you select a vehicle and from there you can make overseas investment. To give a very simple example, let's say Indian company wants to invest in various countries outside India, say Australia, Japan, New Zealand, England, various other countries. And it has decided that I want to route maybe my investment through a specific entity. So they are forming, say, a special purpose vehicle or SPV, what we call, in a particular, in say Singapore. So Singapore will be the main vehicle where Indian party will invest, and then all investment that are made in other countries, any other countries are routed through that. So Indian parties have floated a particular SPV, and from there investments are made, downstream investment or a step down investment as what we call in various other countries. So that is allowed under the law, provided that vehicle is just one. We saw, the cases where investment is allowed under automatic route. Now let's look at the cases where investments are require approval of RBI. So anything in terms of eligibility, what we saw here in terms of allowed, if any of these conditions under automatic route, if Indian party is not able to meet, then they need to take RBI approval. So let's say that 400% of net worth is not met. Say Indian party is a loss-making company, right? So if the company is a loss-making, there is no way it will be having any positive net worth. So even a rupee investment overseas will also then it cannot make, because they don't have enough threshold. So those cases, so that particular case where a party is a loss-making, or if you want to make investment much beyond your eligibility criteria, you need to apply to RBI and take case specific approval for investment. Also, even if your investment is well within 400, but the Indian party exposure is huge. Now this especially happens in the case of big conglomerates, where the exposure amount is quite huge. It runs into billions of dollars. So in that case, you need RBI approval or making overseas investment. So take first approval, and only then you are allowed to invest outside India. Now what while all these cases that goes under approval route, there is some decorum that and the rule set which RBI laid down, which needs to be fulfilled. So various factors are considered while evaluating any application from any any company when there is an investment made. So important among them are, that how is that project viable? So if anybody wanting to make overseas investment, then RBI would prima facie see the viability of the business of the overseas company, how much it will contribute to the external trade and benefit India in terms of the return or reward it will get, because having invested, the one would always look at reward and return back. So how it will facilitate external trade. What is the financial position and a track record of the Indian party? Obviously, the Indian party, should not get into any scanner of a regulator, be it SEBI, ROC, Enforcement Directorate, any of them alike. So make sure that the track record is as clean as possible, financial position, balance sheet is healthy, so that there are no questions from RBI in terms of the ability of Indian party to make overseas investment. And another important aspect in terms of expertise and experience the Indian party has in the related business, which they want to invest overseas. So same line of business, it adds further to the criteria, and you are able to kind of meet one of those additional things for making when RBI makes the evaluation or the application. Question, we did, I covered those valuation scenario. Now there is an Indian party which is wanting to invest overseas, and the investment is $4 million. Now, we saw that 5 million or more, you need merchant banker valuation. Less than that, you can do it from a chartered accountant or a local, a CPA of the host country. Now, here is a case where Indian party is saying that I want to make overseas investment for $4 million. Can I take the valuation from the merchant banker? So maybe I think a point for you to ponder over, is it something which is allowed under the ODI regulation? Okay, so the position is very clear. RBI has set higher benchmark for in terms of taking valuation from merchant banker for investment exceeding certain threshold. So in that sense, nothing stops Indian party to take the valuation from merchant banker even if the investment is less than 4 million. Yeah. So the answer for this is yes, that it is possible to do that under the regulation. So we can take the valuation from merchant banker even if the amount is less than $5 million. Now, wherever there is a host country regulation stipulates that an investment into the country needs to be routed through a designated account. Now, typically what happens is Indian party makes investment into the foreign company's account. They'll open a subsidiary, then they'll invest the money and transfer the money there. But certain times, and which I have faced, especially in a country like Sri Lanka, which the host country requires that you cannot form a company in that country without first opening the account in your country. So in that case, if there is an Indian party, say ABC Textile, and if they want to form a subsidiary or a joint venture in Sri Lanka, then it is the law in Sri Lanka requires that first you pump in the money. Now, obviously, there is no entity in Sri Lanka, so there can't be any bank account of a Sri Lankan entity. So, under certain situations, Reserve Bank allows Indian party to open bank account of Indian party in that host country because of the host country's requirement that you first pump in the money, put the money, and then you incorporate a company. So Indian in party in this case will, ABC Textile will actually open a bank account in Sri Lanka in the foreign currency, put the money from, transfer the money from, the India to Sri Lanka, and thereafter, have the company formation done. So in that case, RBI allowing to remit the money towards investment, not directly in the bank account of the investee company, but in the bank account of the investor, which is open in that host country because of the specific requirement of the law. Certain conditions to, which a foreign party, which needs to be kind of complied is that the moment the Indian party have opened a bank account in Sri Lanka and transferred the money towards capital, the money should be, immediately be invested for making investment, and it should not be used for any other purposes. And then there are certain conditions like in future, as and when the foreign party, declares dividend, or there are any amount which an Indian party is required to receive, those should be received within 30 days. So an exception to a case which RBI has created because of, certain specific requirement of the host country. So RBI is, very much alert to it, and is kind of, allowed even Indian parties to have open a bank account overseas to meet the overseas country jurisdiction requirement as well. Doing business, especially, if you are in software or in financial service or, in various other sectors, giving guarantee are one of the very important, criteria to run the business and to, also gauge momentum and, expand the customer base. So certain times, the Indian parties are required to give guarantee. And the way Reserve Bank deals with this matter is very simple. If you have an investment directly in the company, overseas company, JV or WS, nothing stops you. Indian party can give guarantee, can give loan to the immediate, the WS or JV. But even if you have a step down subsidiary or a one level, subsidiary below the main operating company, then that is also allowed by RBI under the automatic rule, provided everything is within the 400% of threshold. If there is a corporate guarantee to be issued for a second level subsidiary, so Indian party have floated a SPV in, say, Singapore. Singapore has formed a company in, England, and if the England entity requires corporate guarantee, Indian company can give that corporate guarantee. Now, let's say that England company has in turn formed another subsidiary of itself, either in England or any other jurisdiction, and that fourth company, the subsidiary below England, requires corporate guarantee to be given, and if Indian party were to give that guarantee, then that is allowed by Indian party, because if the whole of the investment is, if directly or indirectly, the stake is 51%. So here, since the investment is routed through SPV, Indian party has, if they have at least 51% stake, then the guarantee is allowed under the approval rule. So for the guarantee to be given by the subsidiary of the England company, Indian party is allowed to give that, but with the approval of Reserve Bank under the approval rule. This is an interesting, provision. Especially, I think, these things have taken more momentum in the lockdown. We have seen that, stock market has, boomed up in last, after the, initial downfall due to pandemic, but thereafter there is an uptick which is happening, like every day. And also the interest is shown by Indians to invest overseas. And individuals are, not far from that race. Even they are, investing in overseas. So investment in overseas JVWS are allowed only by way of are allowed by way of equity or compulsorily convertible debenture, compulsorily convertible preference shares. So individuals cannot invest in a redeemable preference shares. It cannot invest, it cannot give loan, it cannot give guarantee. It has to be only equity or a convertible, compulsorily convertible preference shares. That activity has to be bona fide one. Indian party, individuals cannot float a company or a JV or a WS overseas which is engaged in, say, financial services. So something which is akin to NBFC business, or any financial stock broking, merchant banking, or anything like that. Individual cannot form a company overseas, and that company cannot be engaged in any banking or financial activities, or even for that matter, real estate. So it has to be hardcore operative business, be it manufacturing, trading, or software or anything, but it cannot be banking or financial or a real estate. Individuals should not be on the caution list of RBI or on a defaulters list. Investment is allowed. Now, for an individual, there is no net worth requirement. All that is allowed maximum is up to 2,50,000 US dollar. So this is a liberalized remittance scheme which is there, which RBI has given, under which individuals can send money abroad to their relatives, or for their travel, or for various purposes and medical, education, and various activities. So under that same, there is a 2,50,000 window overall, which is allowed under LRS route. So investment is also allowed for an individual to make abroad within that 2,50,000 ceiling per year. So this limit is for financial year. So if 1 year if you have made investment, if you have to make another investment of equivalent amount, then you are allowed to do in the subsequent year. So no exhaustion or exhausting of any limit on a cumulative basis. This limit is per year to year. If individual, the investment is allowed from EFC or RCF, resident foreign currency account within the prescribed limit of LRS. The entity, overseas company which you form, it has to be operating company. No step down subsidiary can be acquired or set up by the overseas company. So as I said, you set up manufacturing company, individual, Mr. A, setting up investing directly in the equity of US company, which is engaged in, say, trading, textile, manufacturing, software, anything is allowed. It cannot have a downstream subsidiary or a step down subsidiary. So the investment is allowed only at the operating level. That operating company also cannot have any subsidiary below it if an individual has invested. This is an important point to be kept in mind. Valuation norms are there. I think similar to what a company is allowed to, Indian parties allowed to do. That is, $5 million merchant bank, more than $5 million merchant banker, less than that by chartered accountant. Same thing, even the individual will have to follow if they make any overseas investment. If the individual wants to exit the overseas investment, maybe because it has earned, the return which it has in mind, then it's allowed to do that only after the cooling period of 1 year. So there is what we call as, the lock-in period. So while there is no lock-in period for overseas investment, but if you have to disinvest, then you can do that only after 1 year from making your first remittance. And then only the sale can be sold and you can repatriate the money back to India. Write-off is not allowed for an individual, and any funds which are repatriated to India, sale proceeds of the disinvestment or a sale has to be repatriated back to India within maximum 60 days. So those are the timeline one has to comply with for making the if one wants to liquidate their overseas investment. So this is a balance sheet extract for a list for a company. It has a paid up capital of 50, general reserve of 500 of 100. There is a loss of 50 and securities premium of 100. Now the question is, what is the net worth of the ABC? So maybe I think you have your own calculation and working for it, and I'll just go straight on the answers. So when you have to calculate the net worth, the item which you have to consider is the paid up capital plus general reserve minus accumulated loss. So we are back to 100. Security premium has to be altogether ignored for the purpose of net worth calculation, the ODI. So then your base of 100. So your existing finance. So what is the existing financial commitment? Existing financial commitment, as you can see, is 150 plus 50, and there is some performance guarantee also given of 200. For performance guarantee, the weightage is 50%. So 100, half of it will be taken. So 200 plus 50% of 200. So in all, 300 will be considered as your eligible existing limit. And then whether proposed investment by ABC. So ABC wants to invest 200 in Q Inc. It has the net worth of 100 that takes them to eligibility of 400, and there is an existing exposure of 300. So if ABC wants to invest 200 in Q Inc., since it has exceeded, it will exceed the overall 400% limit, it will require approval of RBI. Another scene, there is no direct investment. ABC has invested into SPV, and SPV in turn has a subsidiary in USA, and this subsidiary in USA requires guarantee or a loan. So as I mentioned in the beginning, as long as the Indian party has indirect stake of 51%, then it is allowed to give guarantee or even the loan to the downstream, one level downstream subsidiary, or a one level step down subsidiary. This is a very interesting case that I came across very recently. There is an Indian company which is which in terms of net worth there are no there are no prohibition, but somehow there are some litigations going on. There are enforcement directorate pending investigations happening. So because of which Indian party, this ABC, cannot make any overseas investment. Now this ABC has two companies already overseas. One is located in France, another in US. Now this US company is in need of funds, and it's saying that now ABC will remit the money. But if for ABC, if they have to remit the money, since it is into that the blacklist or something, they are not able to do. So they are saying that fair enough. There is a company in France which is already having profits, has surplus. So simply France WS will give the loan to the US WS. So these are the two countries, two entities located outside India. From the ODI point of view, if France WS gives any loan to the WS of US, whether any filing is required to be done by ABC with under the ODI regulations. So the position is that this is the transaction happening between overseas party. FEMA in this case it doesn't apply. So there is no filing of ODI which ABC has to do if France is giving loan to US. Also the 400% limit of financial commitment, that also will not come into picture, because it is straight away the transactions happening between the overseas party.
Sir, here before we move ahead to the method of funding, I would suggest there are a few questions if you could attend that, because they are with the flow of your session. So by the time it passes, the flow would be subdued. So a request, sir, please, if you could.
Sure. Please. Let me. I think you have put something in the chat. Let me just see that.
Exactly, sir. Exactly.
Yeah. Just a moment. Okay. Providing loan to an so question is, providing loan to an outside entity is not covered under direct investment outside India. So is the regulation different? Okay. So if the Indian party is not covered under direct investment outside India. So I presume, the situation is that Indian party wants to give only the loan without having any equity. So if there is no equity, exposure, then it is not allowed under the automatic route at all. One has to really make a case for it to RBI and explain to them that why they want to give a loan, because there is no direct equity exposure by the Indian party. And there are no separate rules or regulations in this regard. One has to, make a case specific application, give the bona fide, and then, kind of justify to RBI. But let me tell you, practically, in the rarest of rare cases, such approval by RBI is given where there is no corresponding equity investment. What about newly incorporated company having negative net worth? So, I think this, I did mention about situation where we have a approval route, automatic route and approval route. Now, if it is a new company or if it is a company with a loss making situation, or there are, the net worth is negative, then obviously, we will not be able to have that 400% criteria. So we will need RBI approval for making any overseas investment. So, be it rupee 1 also, one has to make an application for approval of RBI. Okay, very good question. Like inbound investment for ODI, is floor and ceiling price applicable. It appears that there is not coming out from the regulation. So I think, yeah, the participant has raised a very valid question. But again, from a practical point of view, when we talk of FDI, somebody has to invest in India. There is a floor price. So any money which is then coming in India, it can be more than that floor price. Okay, because this is seen from the point of view of protecting the, the country's interest. So similarly, if I have to make overseas investment, okay, when there is a valuation done, we have to ensure that in the valuation, the investment is not beyond that price. Okay, any investment which goes above that price would be questioned by AD Bank, will be questioned by RBI also, because then, we are giving away more than the fair value of that company arrived at by the learned, the valuers. So it is unwritten, okay, not something there in the black and white, but, from the practical experience and the way the scrutiny of applications happens, we have to make sure that we do not invest a price. Certainly not, if some variation, 1 or 2%, maybe, it may be allowed, but any higher price above, the valuation is not allowed. So one will straight away get a show cause notice or a query from regulator. Okay, I think flavor of the season, crypto. Will the overseas company which deals in crypto treated as financial service company? I think the regulator, RBI, government is trying to, find some ways and means to address the crypto market in India. Now we are talking that Indian party wants to invest in a crypto company which is located outside India. Will it be considered a financial service company? So, the way they operate. So while, there is no underlying security which is there, but ultimately they give, the uptick or the rise in the underlying investment. So from that point of view, investment overseas in a crypto would not be, as an ordinary manufacturing or a trading activity. It will go through that lens of a financial service. Yeah. Any other question, Mr. Khan? I think I have tried to answer. Okay.
So please go ahead.
Yeah, no, I think the questions were posed at the right time. I think it was good that I took that and you draw my attention.
Thank you so much, sir. Thank you, sir.
So, another important now, the way the investments are, made. Indian party, the remittance of fund can happen through various ways. These are the routes which Reserve Bank has laid down. One can have investment in overseas JV or a WS by, drawing the foreign exchange from the AD Bank, or if Indian party have exported the goods and, in that customer, Indian parties have found interest and wants to, and, there are commercial or business case to kind of, have a stake in that. then instead of the exporter, that customer paying the export dues, and then we again investing money under ODI, the law allows you to simply capitalize your export. Swap of shares, Indian party, foreign party are exchanging shares of each other. That is allowed. There is no funding actually happening. It's just share that moves and documents and a valuation which happens. Any use of the ECB, the external commercial borrowing, the money that I've raised from ECB can be deployed or used for making overseas investment. It can also be, invested in exchange of ADR, GDRs. The balance earned in exchange and a foreign currency account. It's typical that, exporter to avoid and minimize, the exposure on exchange rate every time, the export proceeds are released, realized, they simply open a EEFC. It's an exchange and a foreign currency account where, the money lies in a foreign currency only. So it's say a dollar or euro or whichever account there it is. From there, Indian party wanting to make overseas investment, it can use the proceed from EFC account. And the last is proceed from foreign currency funds raised through ADR or GDR. So in the last two routes, the 400% limit doesn't apply. For above other limits, other provision, the limit applies. Pledge of shares. Now, let's go into some different kind of, areas and aspect which is laid down by RBI. Indian parties, if they have made investment in overseas company, and if they were to pledge that in favor of the Indian banks or any overseas lender, then for availing any fund based or non-fund based facility for itself or for the JV overseas, then the same is allowed to be done. Reserve Bank has laid down certain conditions in one of the circular which they issued in 2014. But those conditions are one has to always meet with it. But essentially, the law requires that there has to be bona fide case. There should not be any existing charge or any lien created. Securities, once created, then it can be pledged. There are clear documentation laid down as to how the pledge will be released. So those conditions, one has to comply with, and then can pledge their overseas investment which they have made. Creation of charge on the assets. So Indian companies can create charge on the assets in favor of overseas lenders or in favor of the AD bank in connection with any overseas investment that they have made. I think similar to the earlier circular, the circular also gives certain additional condition which one has to comply with. Investment in financial service sector. I think Reserve Bank deals with the financial sector with rather consciousness and is always concerned whenever any investments are made. So any investment in an entity outside India which is engaged in financial services is allowed if the Indian party in the first instance is registered with the financial service authority in India. So from the likes of SEBI, RBI, IRDA or PFRDA. So any Indian entity, if they want to set up a company overseas which is into financial service in financial sector, then Indian party need to be first engaged and be registered with any of the regulatory authorities, financial regulators in India. Then the Indian party need to have a profit, need to be having a track record of profit for the last 3 years. Amount is not mentioned, but just make sure that the parties are having recording profit for the last 3 years so that they are eligible. The Indian, if you want to set up any finance company, finance service related entity overseas, then take the approval from the home country before you make invest. So that's a in principle approval or prior approval you will take from that home country, and then you approach RBI or then you route your investment for overseas. And the Indian party, especially, if you are saying NBFCs, or for that matter, any SEBI registered entity, if there are capital adequacy norm mentioned in terms of, having net worth, net owned fund, etc., the Indian parties are fulfilling that. So these are some ground conditions, ground reality condition one must test, one must check and comply with before any investment is made overseas. Unregulated entities in financial service sector in India can invest in non-regulated, non-financial service subject to condition. So unregulated entity in financial service sector means, to give a simple example, if there is a investment advisor and that Indian investment advisor is advising only to the foreign body corporate, that then under SEBI investment regulations, they are not required to be registered. There is a specific exemption. So in a way, they are engaged in a financial service activity, but they are not regulated by SEBI because they are exempt. Now, if that investment advisor wants to make overseas investment, then first they need to go to SEBI, get registration, and then only comply with it. If they want to invest in financial service, if they want to invest in non-financial service, then it is allowed. Another instance could be the core investment company. Last year, the regulations have changed. Earlier, they used to call it as CIC and systemically important CICs. Now there is only core investment company and unregulated or non-registered CIC. So if there is an Indian CIC which under the Indian law is not allowed, or rather is not required to be registered with RBI because it is investing only in the group companies. And if that company wants to make investment overseas into financial service activity, then that CIC will have to be first registered with RBI, and then only they can make overseas investment in financial service sector. If they want to invest in non-financial service sector, then it is allowed under the general condition, which is ordinarily allowed to various other manufacturing or trading or software company, which we saw in the beginning. Trading in commodity exchange overseas and setting up of a JV or WOS in overseas exchange is reckoned as a financial service activity, and this will require approval or clearance from the SEBI. So round tripping, this is one very touchy topic for a regulator, for enforcement directorate, and even for the tax department. Okay, any money which goes from India and comes back to India in some different form is simply called as routing the funds to kind of just avoid taxes or some money laundering or some other activities. So Indian parties are not permitted to set up any subsidiaries, or through its Indian party are not allowed to set up Indian subsidiaries through foreign WS or JV. So simply it means if there is a company in India, okay, and if it has we want to set up a JV or WS in say USA, and if US company wants to in turn set up another company in India, or wants to acquire shares of some other company in India, then it is like Indian money going abroad and foreign money again coming back to India through a foreign channel, through a foreign vehicle. So typically it is called as a round tripping. Money goes out, money comes back in India, not necessarily the same company, same pocket, but it comes to India. So it is not allowed under the automatic rule. We will see later on during the this subsequent slides that there are certain genuine cases where it is allowed by RBI, but any such route or a vehicle or a channel which is created, then you need approval of Reserve Bank, not allowed under automatic. So one has to make an application, and RBI will decide on the merits of the case on a case-to-case basis. I think this we saw, especially again, I'm talking of lockdown time. RBI had, initiated show cause. Had initiated inquiries, issued a lot of show cause notices to various companies, which had, such past such investments like that, and they even approach individuals, especially, the likes of HNIs, where Indian HNIs invested overseas, and then overseas company have again funded some other Indian company. So RBI has issued a lot of show cause notices, and I understand many of the cases have gone into kind of compounding settlement, and the penalties are levied for such cases. So anything which is done through this route without RBI approval, there's a short case of a show cause in notice, and then subsequently even compounding, and RBI would even ask to unwind the transaction and take the money flow back. So it's like you take the money back and unwind the transaction. So why is the country regulator, Reserve Bank, so much concern about round tripping? Now there was this Vodafone case of indirect investment in 2012. Supreme Court passed that landmark judgment, and it kind of gave a retrospective effect uh, to the provision of Section 9 under Income Tax Act from 1961. In that judgment, interestingly, they have also touched upon round tripping, and these are some of the some key excerpts from that regulation, from that judgment. So Supreme, these are all the the words and language of Supreme Court. So one of interesting thing is that round tripping involves getting money out of India, say Mauritius, and then come back to India like FDI or FII. To give an example, if a structure is used for circular trading or round tripping or to pay bribe, that such transaction, though having a legal form, will be discarded by applying the test of fiscal nullity. So then it will be like, you will see through the whole structure and say that no, this is nothing but a sham. Certain, I mentioned that many a times the company do resort to such circular investment to avoid taxes. So anything done to avoid tax, obviously there is a concern which the tax department has, and the whole tax benefit can be lost apart from getting any penalty and show cause from RBI. So let's look at this very simple example. There is an Indian company X Limited which has investment outside India in Y. Y Inc. has then invested in a proposing to invest in a company called Z Limited, which is in India. So this above the line is India, below the line is overseas, and Y wants to invest maybe very minuscule 0.1%. So there are no threshold, by the way, laid down by RBI when it comes to round tripping, be it 1 share or 100 shares or 10% or 100%. Anything is get covered here. So this basically the money is flowing from India to overseas, and then the money and that overseas party is investing in again Indian. It is considered as a round tripping, and it is straight away not allowed by Reserve Bank. And whether then Z Limited, whether it is listed, unlisted, it doesn't matter. So even if the foreign company invests into the Z Limited, which is a listed company, and say it invests into stock shares from the market, but nonetheless, there is a round tripping done. So not allowed by Reserve Bank. We'll see some of some interesting situation and the compounding order which RBI has issued on ODI, and which also has touched upon the round tripping matter. Investment, in the cycle of any investment, one makes investment, then there is a reward to it in the form of dividend, and also many a time you exit and sell the shares. So in case of disinvestment or a sale of shares that happens, essentially the RBI laid down two kind of parameters. One in which, there is no write-off involved. So if Indian party has made investment overseas, and is getting at least the value of what it has invested in the past, anything more than that is fine, but at least bare minimum should be there. So that is something which is, called an automatic route. So where there is no write-off allowed, no write-off involved. In case there is a JV, or in case of listed joint ventures or overseas, sale is effected through the stock exchange, then there the Indian party can sell their shares in the market and get the money realized. If the overseas JV or WS is not a listed, and it is done through a private arrangement, then the sale value shall not be less than the value certified by a chartered accountant or a CPA. So here, the valuation is required, can be done by any CA or a CPA, and Indian party need to ensure that the sale price is at least the minimum of the value given by the valuer. Anything more than that is perfectly fine. There are no outstanding receivable by your dividend, technical fees, royalty, etc. So all your export proceeds should be received. Nothing should be outstanding. So it should not happen that you sell the shares of that company, but then you have some dividend receivable or some commission or some other export proceed receivable. Everything has to be realized within 60 days period laid down by RBI. There are some requirement in terms of filing APR, which is like a process in terms of filing which has to be done. So which should be done timely from the past. So all filing need to be there, properly done to avoid any. So if company has not done any past filing or APR and is considering to sell the shares of that overseas company, then Indian party just need to make sure that it is completing its all the past backlog of filing regarding APR with the AD bank to see that its records are up to date and duly filed. Indian party should not be under any investigation by CBI, SEBI, IRDA, or any regulatory authority, and the sale proceeds must be realized within 90 days. It happen that as a part of the business and a venture, the investment that you make do turn out into losses. So not that one can always guarantee the success or the short return on investment. So if there are losses happening, and if because of the sale or a divestment or a disinvestment that is happening, the Indian party is getting less than what it amount originally invested, then in certain situation it is allowed under automatic route, that is without RBI approval. But those are the cases where the JV or WS is listed in the overseas market. So if Indian company has invested shares in foreign JV, and if that foreign JV is listed, then the sale can happen at the market price. So even if that happens at a loss, Indian party has got less than what it had originally invested. Such disinvestment is allowed under automatic route. If the Indian party is listed on stock exchange, the seller. So this situation we are talking of the Indian seller company, the investor company. So if the Indian party is a listed, and if it has a net worth of at least 100 crore, and if their overseas investment is sold at a loss and it involves a write-off, then again allowed under the approval route, under the automatic route, where the Indian party is unlisted and the investment in overseas venture does not exceed $10 million, and if the sale results into write-off, then it is allowed under automatic route. And then the fourth scenario is where Indian party is listed, it has a net worth of less than 100 crore, that is not fitting in number 2 here, but less than 100 crore, but the investment does not exceed $10 million, then also such disinvestment or a transfer is allowed, even if it is done at a if it involves write-off. Now in case any of this situation is not met, then prior approval of RBI is required, where you'll have to give the case specific case application, reason why the company made losses, what are the commercial justification for that, and then take the after taking the approval, you can disinvest the overseas company shares at a loss. Insolvency, bankruptcy, I think are the norms there abroad, and also it is now after the passing of IBC, we have seen many companies going for it. So because of if restructuring is required in a particular company, especially in the overseas company, and if that results into any write-off of capital or receivable, then the law allows you to restructure that balance sheet as long as the Indian company has at least 50% stake in the overseas company. So if then depending upon which the Indian party is, if the Indian investor is a listed company, then up to 25% of equity investment, if that results into the write-off because the restructuring of the balance sheet of foreign company, then if you are a listed company, up to 25% of investment is allowed on automatic route. And if the restructuring balance sheet of foreign company results into loss, and if the Indian party is unlisted company, then they need to take RBI approval, regardless what that percentage is, be it 1% or 5%. But maximum amount or a write-off which RBI would allow under the approval route is 25%. So not below that RBI would allow. So in two situations, the write-off is allowed. For a listed company, RBI has been little lenient, when it comes to disinvestment also, which we saw in the earlier slide, or for that matter, even now, for the restructuring. So it's being little lenient for a listed company, and some tough norms stringent norms are applied for an unlisted company. And any such restructuring done, write-off done, the same needs to be reported to AD Bank within 30 days of the restructuring happening. Okay, some of the some process driven conditions or the obligation which an Indian party needs to ensure. It has to intimate RBI within 30 days post investment. So money has to, but typically the way it happens is that you will always give the document to your AD Bank for the review confirmation in advance. When they are okay, then you will actually remit the funds and then do that formal signed application with of form ODI along with the documentation to the AD Bank. Once you invested overseas, make sure that you receive share certificate within 6 months and keep your AD Bank informed for that. Having invested overseas, if there are dividend to be received or there are any trade transaction with that party, that overseas JV or a WOS, then any receivable of this nature has to be received within 60 days. If this amount are not received within 60 days, then any future divestment or a sale would come under scanner and may require even RBI approval. If you sell any shares of foreign company, then a fund needs to be repatriated within 90 days. There is this requirement of filing APR in part 2 every year. So April to March, the due date to file APR is by 31st December. So for the the year just ended March 22, the due date for filing APR will be 31st December 22, which has to be based on the audited accounts of the JV or WS. Unless if the JV or WS are not required to get their accounts audited under the home country, then you can file this based on the management certified accounts. Also, obligation for Indian party who has made any overseas investment to file a FLA return, and that due date is 31st July. So if Indian party has made any overseas investment in JV or WS, say in year 1, then obviously, in the next year, by 31st July, they need to file form FLA with the return in FLA. Let's say after first year of investment, in the next year 2, year 3, year 4, there are no investment, no overseas investment happening. Whatever the Indian party has invested overseas, it is just staying there. No further investment is done. But the obligation to file FLA, okay, that meter has started. At the moment we have Indian party has any overseas investment, then regardless there is any change in terms of sale or any additional investment or anything, unless we have exited fully, if there is even a one share held, as long as the Indian party has overseas investment, the FLA return will have to be filed every year. Capitalization of funds, we did, I did mention in the beginning the various source of funding the overseas investment, one of which was capitalization exports. So this is, getting a little more detail into it. So, any payment due from overseas party towards exports or fee or royalty or technical know-how, all of this can be capitalized under the automatic route. You need to get the valuation in place, do the filing of form ODI with ED Bank, and have that thing done. Capitalization export proceeds remaining unrealized beyond prescribed period of realization requires RBI approval. So, export proceeds, there is a timeline of 9 months to realize it. If you are capitalizing within that time, then it is fine. Nothing, no approval required. But if that capitalization exports happens beyond 9 months, then you need RBI approval for having that converted into your shares of overseas company. This is, RBI has given more favor, what you call additional benefits to the software companies, and they are even allowed to receive 25% of their exports by way of, in the form of shares. If there are, they want to have that overseas client become a kind of a strategic, client and investor as well. So 25% of export is allowed to be capitalized. Now, these are some important FAQs which RBI has issued. I mentioned in the beginning that there is a section 8, which is a mainframe provision. Under that, there are ODI regulations issued. There are master direction issued by RBI. And then, if there are any amendment that were to happen, RBI issues by way of a EPDI circular. But beyond that also, there are some of the cases where RBI need to, give more clarity. So this is the case where, they have issued several FAQs. What I've listed here are some of the key, FAQs which are important. Maybe I'll touch upon few of them. That can an Indian party, which is or a resident Indian, acquire shares of foreign company without upfront payment or on deferred payment? The answer is no. The regulation, FEMA regulation, do not permit acquisition without payment or deferred payment. So first, the payment has to happen, and then you own the shares or acquire the security. Can an Indian party set up step-down subsidiary or a JV in India through the foreign entity? So this is that round-tripping case. I had just showed that slide earlier. Indian party making overseas investment, and if that party not necessarily investing in India, the same company. So this is not that case. Let me just take the slide back to that particular case. So if X has invested overseas in Y, the round tripping is not Y investing back in X. Y investing back in India in any company is also a round tripping. So any such flow. So this has been very clearly captured by RBI in their FAQ number 64. So one need to make an application to RBI for investment. But here there is a we see this very frequent among the software companies. which are always, looking for acquisition and into the shopping spree. So, listed software companies, we name it, and we see that every 3 months, 6 months, some big announcement of overseas investment happening. So what happens is typically Indian company is looking for target overseas, and the overseas target may be having presence in multiple countries, including India. Now here is a case where, say, Infosys is wanting to acquire some target, say, company based in Europe or in UK, and UK has presence in multiple companies, including India. That presence was already established and there long back, even before Infosys, say, has even shown any interest. And if Indian company were to invest, into UK company, since they have one leg in India in the form of investment in India, they really cannot acquire that company without taking RBI approval. So a very strange case where the money will not flow from India to UK and UK to India, because UK already has investment in India. But after the acquisition happens, India owns UK. UK will has an existing investment in India, which is then considered by RBI under this situation. So they are saying that if you contemplate any such acquisition, if there is any proposal to acquire shares of foreign company, which in turn has investment in India, then you take RBI approval first. Generally, if the cases and the merits warrant, and in the instance which I have shown, Indian party is into acquiring targets and looking for M&A deals overseas, and because of that they are present in India. There are very good cases of RBI allowing such approvals and such acquisitions. Can a loan given to an overseas venture be converted into equity? The answer is yes. The loan which is invested can be converted into equity or CCPS. We just need to, do the valuation and get the same converted. And then there are filing requirement to be done. Okay, I think this is something, very interesting one. RBI last year issued this draft regulation. They issued one this overseas investment regulation, and another is non-debt instrument overseas investment rule. So two draft provision, legislation, a piece of rule and regulation were issued. But now it's, I think, more than 7 or 8 months. RBI has not yet issued and notified this still. We have been speaking to some of the AD banks also very recently. Apparently, there is no hint, as to what is the view so far RBI has taken on it. Whether it is contemplating to introduce a new set of ODI regulations, or have some sort of amendment made in the existing one based on the draft. But essentially, there is a radical change in which the whole ODI provision will happen. They are introducing a concept of ODI. They are introducing a concept of overseas portfolio investment called OPI, in addition, to ODI, and they are treated differently. No JVWS. They are saying, okay, simply foreign entity. Step down subsidiary, they have defined. They laid down some detailed rules and regulations for various investment. Even the investment in financial service sector, the rules are set to change as per the draft rules, whatever they issued so far. Gift of foreign securities by relatives, they are touching upon it. They are saying, okay, if individuals have foreign security, then you can give to the relatives. The need to take, the NOC from the lender, bank, lender or overseas regulators, and the pricing guidelines. So I think they touched upon a host of subjects and topics around this. But if one were to, look into this draft rule, it can, actually go into a full-fledged session. But since these are draft, and now since more than, I think, 7-8 months has happened, nothing has, further materialized. So I thought I'll just give a reference, passing reference to the participant, saying that there is something that was cooking up, in terms of proposed legislation, but so far it has not seen the light of the day in terms of having the new regulations or even amendment for that matter to the existing regulation. So I have seen, we have 8 sessions of FEMA, extensive, workshops are there on every day. I think in a couple of days we have one dedicated session on compounding. So I will not get into the nuances of what the compounding is. The learned speaker will definitely touch upon in detail about that. But what I would like to cover today are some of the cases of compounding order, which is kind of issued by RBI. So RBI sets out some rule regulation for anyone to follow. If there are non-compliances in terms of delay in filing, delay in reporting or intimation, or there is some gross violation of the policies, then all of them goes into compounding. So it's not the procedure or a filing or a reporting delay which is considered. Even some gross application of the provision, misapplication of provision will also go. So let me cover a few of the cases, compounding orders. So again, little bit about compounding order is till February 2020. RBI was hosting the order of compounding on the website, but then I think many companies whose order was hosted, and many other trade bodies, industries represented, post which RBI has stopped posting the full-fledged orders. So this is a kind of, and I think they announced that they'll make some on a no-name basis a case summary of various compounding that is done without getting the or revealing the full details of what the non-compliance was and facts of the case. So these are the orders which are there on the RBI portal till February 20, so about 5-6 years. There are several of the orders. We did that study some time back, and what we have covered in this presentation is some of the key kind of secular cases of compounding which RBI has done. So first case is there is an individual who along with his relative has invested in the overseas company, and that foreign company, there is delay in filing ODI. So there is a delay in filing ODI for the overseas investment, and even making overseas investment without receiving the UIN, unique identification number. So any filing of form ODI would result into the AD bank or RBI allotting a unique identification, and that number you will have to quote every time you make future investment or do any further correspondence with AD bank or RBI. Now, in this particular case, money was just invested without timely filing of ODI, and I think after having filed also without getting a unique number, another investment was made. So this, and then even the APR, annual performance reports, there was they were not filed within the stipulated time. So all this goes into a violation. So these are the provision of various FEMA ODI regulations which are kind of not adhered, and RBI said that this would result into compounding. So the amount involved at stake in terms of whatever amount they invested was some 1 crore 60 lakh, and the delay in various filing or overall contravention period was about 1.5 years. So RBI levied a penalty of 16 lakh on that company. So just roughly 10% of the amount involved. Another case, Indian party has invested. So there is an Indian company which has which has stepped down investment in another, the Indian company. So Edison Technology Holding, okay, with an intent to expand its business, has acquired shares of Edison Mauritius. Now this Edison Mauritius, incidentally, was already holding shares of Edison Technology. Now, while the name is all common, there is no incidental, because as a group, the investment already there. But maybe that particular, when the investment has gone from Edison Holding to Mauritius, the fact that Mauritius already held some shares in the Indian company, was kind of not reported. So that, caught the typical case of that, round tripping. So when the application was filed and, the AD Bank, RBI processed it, they got into details and they said that this would require compounding. And, the amount involved is huge, because the investment was of 572 crore and the delay which they observed was more than 3 years. So a penalty of 3.7 crore levied by RBI. So the the result structure amounted to making ODI in an entity with a pre-existing FDI. This is something which was not allowed under that FAQ 64 that I mentioned. So this somehow, was overlooked. So the RBI told not only to make an application for compounding, penalty was levied, but it said that you will have to unwind the transaction, the FDI leg as well as the ODI leg. So, the party had to reverse or rather sell, as what he called, and to, put back to their whatever initial stand was. So the whole structure was asked to unwind. Companies are asked to unwind their transaction. Indian company, it has a WOS in Hong Kong, and the Hong Kong WOS in turn has a step down subsidiary in Canada, and the Canadian company needs some support. So Indian party, the top co, the holding company in India, they gave the standby letter of credit to step down subsidiary. Now, as you can see, there is no direct 100% investment here. And SBLC and this standby letter of credit generally is there for a period of some defined period, but then it was renewed again and again 4 times, and none of those instances were reported to AD Bank and RBI, and this actually amount to issuance of guarantee in favor of step down subsidiary, where they needed to take the RBI approval. So the matter went to the compounding, and the amount in default that was involved, the SBLC amount that was there was about 3.54 crores, and that continued for almost 3 years. So a penalty of 8 lakh was levied by RBI. Investment, exceeding the threshold of 400%, that also gets into compounding. What I am allowed to invest, Indian party is allowed to invest, it has invested more than that threshold. So it was, a straight away violation of the basic norm. Also, the Indian party gave some open-ended guarantee to the foreign, foreign on behalf of the foreign party. So, whenever you give a guarantee, there are some terms and conditions in some defined period. But here there was no defined period, it was open-ended. Regulators found that this could be, proved to be very risky for the Indian party, something which is not allowed. Then even issuance of guarantee on behalf of step-down subsidiary, when it was not enabled under ODI regulation. So, what we saw earlier was something HDS is allowed. So indirect subsidiary, Indian company can give guarantee, or for that matter, step down subsidiary, but these provisions were, allowed, not, in the good old days. Earlier, those laws were not there. Subsequently, RBI allowed. But when this structure was, transaction was executed, there was no specific permission to give. And since it was given, they said it is a violation of the law. And even some of the filing in terms of APR, which was required, was not done timely. So again, they calculated the overall exposure in the period of default, and a penalty of 1 crore was levied. 1 crore 20 lakh was levied for the amount in default of about 180 crores, which was running for over 9 years. There is, Indian party making investment overseas, and if there is any change in the capital structure that happens in the overseas company, the Indian party is required to, intimate the AD bank and RBI. Now that's something that didn't happen here. Indian party had invested in the Sri Lankan entity, and the Sri Lankan entity made some right issue. But because of the right issue, depending upon which people subscribed and did not subscribe, there was a change in the shareholding of the Sri Lankan company, which was not reported to RBI at all. So the matter went into compounding, and then penalty was levied by RBI. There was a delay in reporting the change in the capital structure, and also in this case the APR filings were delayed. So both were considered, and the penalty was levied. Non-repatriation of interest. The Indian party has made overseas investment. It has now Indian party has given loan to the foreign WS, but the interest was not received within 60 days or whatever due date was decided. If the amount was not received, RBI said it is a violation of the fundamental provision of the FEMA ODI regulation. Come make an application for compounding. The amount in stake was about 21 crore, and that non-receipt of interest was running for a long period. So, almost 11 years. So a penalty of 15 lakh was levied by RBI. So I think we will definitely see several of such instances. The idea of just giving our listing down are some of the cases which one has to always keep in mind. Whenever one makes an overseas investment. This is another case where holding where there is an overseas company. Indian party has made investment overseas, and it has also given loan to the overseas party. So while the Indian company sold the shares of Bellissimo Holding, the loan continued. Now we saw in the beginning that you can give loan or a guarantee to overseas entity if you have equity investment in the first instance. Now here equity investment are there, loan was given, everything was done, but then I sold the shares. But if I sell the shares, the law requires me to even get the loan back. That was not done. When the shares were sold. So it was then amounting to exposure by for loan without corresponding equity. So it's a violation which was noted, and the amount in default was about 2 crore 10 lakh. So the penalty of 3 lakh 50,000 was levied. I think one last case. It's a case of a round tripping. We see the Indian party here. Halcyon Finance. They set up a subsidiary in Singapore, namely this Infra Health, and remitted $2 lakh and some additional amount from time to time for the acquisition equity. This was all done in July 2010 and then July 12. And then in July 2010, the WS acquired entire stake in Radiant Life, the Indian company. So India making investment in Singapore, Singapore company acquiring shares of some target in India. So as I mentioned, the fund has not flown from Helicon to Infra Health and Infra Health back to Helicon. It has asset gone to some other pocket, other bank account, but within India. But so since the money has gone from India to overseas and flown back to India, they said it's a round tripping. It's a case which requires compounding. The amount in stake was 64 crores, and that instance, that contravention continued for 6 years. So straight away, the RBI had levied a penalty of 2 crore 30 lakhs. So RBI, if such instances are seen, we have seen that earlier case also Harrison, that they said to unwind the transaction. Depending upon the gravity of the matter, when the round tripping is done, there is a big rigor of not only paying the penalty, but even RBI asking to unwind the transaction and take back the money and settle and have then zero exposure is very likely. So whenever there are such circular kind of structures being thought or planned or maybe perceived because of some acquisition, one has to be very careful. And depending upon merits of the case, one should make an application and take prior approval of RBI before they contemplate any transaction.
Sir, sorry to interrupt again. There are a few questions starting from number 6. So if you could go to the chat box, you'll find these questions mentioned over here.
Okay. Can an Indian resident invest in foreign LLP? Okay, so if that Indian resident is a Indian company or a LLP, then they can invest in foreign company. But if if it's an individual, individual can invest only in equity. So foreign LLP will be, or for that matter, even LLC, which is there in jurisdiction like US, will not be allowed. So company investing, Indian party, which is a company or LLP, investing in foreign LLP is definitely allowed. Next question. What if, for example, the outside company is in loss and the Indian company plans to write off the whole investment? What provision shall apply? Yeah, so I think there are some detailed, conditions depending upon whether Indian party is listed, unlisted. Then if that because of the overseas company loss, if the balance sheet has to be restructured and that results into write off of Indian company's investment, it is allowed within those parameters we just discussed. So depending upon facts of the case, one has to see. But yes, provisions are there to say that yes, if because of business or whatever, if there is a loss, then you can definitely write off can be taken either under automatic route or approval route, depending upon conditions that you satisfy. Is there any time limit prescribed for making payment for making ODI? So we saw that first that one of the FAQ addresses this. First, we have to make investment, and then only we can get the shares. So obviously, the money lag has to first happen first, has to be done. So then then the actual investment will happen afterwards. I mean, in terms of getting shares. Will the restriction of deferred payment applicable if the Indian party make ODI through WOS established in UAE or any other foreign country? Okay, so if it is through SPV, then it's a SPV which is making a downstream investment. That particular part, that deferred payment will not be there because Indian party there is no money going at all. Some fleeting question: are Benami transaction regulated under RBI? The answer is obviously the RBI doesn't regulate any such kind of thing. If there are contravention done, there is some daylight violation of the provision, then RBI would AD Bank or RBI will straight away pick up the case and ask for compounding, levy penalty, and if there are situation or the provisions are violation are grave, then even ask to unwind the transaction. Yeah, I think those are some of these questions. Try to answer, I think, all of them. Over to you, Mr. Khan.
There's one more question, sir. Can resident individual make investment in JV, WS in overseas partnership LLC? 11th one.
One moment. I think I did touch upon this particular matter earlier. Investment basically allowed, in share securities. Forming such LLP, I think, will be a doubtful proposition. Yeah. Are there any other more questions that
No,
you
sir,
got?
this is it. This is it. I think we are left with 5 more minutes, so you still have time window with you, sir.
No, so I think I tried to cover some of the key provisions.
So in a nutshell, some advice, some tips for the chartered from a fraternity, that how you would advise them, when they're dealing with these cases. Like, obviously, as a consultant, there would be a lot of clients approaching to them. So in a very crisp, if you could just guide them, especially those who are inclined to get into this now after your session.
No, I think things are very. RBI laid down the rules. The way they are allowing FDI, even the overseas investments are allowed. What all that you need to do is do a proper diligence in terms of first checking your eligibility of the Indian company. Are you profit making company? Do you have net worth? Do you have enough of a threshold to make investment? Get the valuation things in place. If there is some existing company you are targeting, then you look at the balance sheet, ascertain the valuation. Or if you want to set up a new company, then all that you need to do is the groundwork in terms of eligibility. Is the investor covered under any is it at all blacklisted by RBI through that export caution list, or through investigation. I think all those things needs to be done. One is to, as a practical mode to handle any overseas investment, is that, you'll always first draft documentation of, in terms of, even taking a draft valuation report, prepare your forms, valuation certificate, auditor, certificate from auditor for making overseas investment. Give the drafts to your ED bank, let them go through it, let them review it. If there are any comments, suggestion, incorporate that, finalize it, and then lodge a signed document, because there's no point we freezing everything at our end, filing the signed documents, and then later on AD bank finding some fault or a question. So, and this is what we have seen, most of the AD bank also does it, so that you agree upon them on the draft documentation. And once the AD bank also gives their comments and checks and gives the reviews their legal department, then then filing and then subsequent routing money, I think, becomes very easy. So I think have those things done, then remit the money, and then simultaneously lodge the document, so that then getting the allotment number details would be easy. If there is any the AD bank and the Indian party should be on same page. That is a bottom line message. And to do that, there has to be prior conversation, exchange the documents, exchange draft documents, take their views, and see that their changes are incorporated. Of course, based on the law and the facts of the case, so that we don't face any issue later on when we have to actually remit the money and do the investment.
Exactly. So very, very nicely you put it across the entire 2 hour session in a nutshell. We have 2 more questions, sir. If you can attend to them in a minute, then I would conclude on this, sir.
One more.
Question number 12 and 13.
Can an Indian resident individual set up step-down subsidiary in India through foreign entity in which he has made investment ODI through LRS? Yeah. So India, Mr. A has a foreign company in UK, and that UK company is then setting up a company in India. That answer is unfortunately no. It amounts to round tripping, so not allowed because of the FAQ, that's 64 that we touched upon. But say that, okay, some question, I don't know if it is broken somewhere or what. But say, I think maybe, same question, same participant has asked. So similar situation, but say that only 25%, but the whole company is about to close. How can the 25% limit apply? Sorry, I'm not able to link this question to any particular situation.
We'll do one thing, sir. We'll close over here. I
Yeah,
really
I think maybe the question
thank you,
yeah.
Rajiv Saab. Your name, actually, it means alive, and there are various synonyms of alive. You have brought life to this session, especially when you concluded this in a nutshell. And we could have the entire gist of the this 120 minutes session in couple of minutes. Very nicely, you just rounded up, and you talked about the points what as a consultant, chartered should ponder upon and should implement it. So I thank you on behalf of Committee of Economic Commercial Laws and Economic Advisory of ICAI, Chairman Sir CA Dr. Rajkumar Satyanarayan Adukia, Vice Chairman CA Hansras Chok, and the entire participants over here, our technical team. We have got Advocate Jaideep Mehta, CA Sudha Bhushan. We have got Krishnakant. We also have people who are not here, Ajit Saab, Chanda Madam, and Deepika Madam, Shalini Madam. All these people are behind this program. So, and obviously the main driving force, again, I would come to see Dr. Rajkumar Arukia. And I thank on behalf of all of them to you, sir, for giving your valuable time, especially on a weekday when professionals like you are very busy. And doing this for the fraternity is really hats off to you, sir. Really hats off to you, sir. Thank you so much, sir.
Thank you. It has been my pleasure as well. Thank you again, to the whole committee and for giving this opportunity. If there is, if anybody has any question, you can feel free to contact me, and I'll be happy to, connect.
Very nice of you, sir. Thank you so much, sir. Once again.
Thank you.
Thank you, Sudha
Thank
Madam.
you, and good day to everyone.